everybody for taking the time to join us this afternoon or this evening or wherever you are. Just as a reminder, we will be recording this webinar. So if you have to leave early or if you want to review any of the material that we've covered, we'll be sending out a recording later on. We'd like to keep this informal, so please feel free to ask questions whenever they come up. There's a couple of ways you can do that. You can either send a message through the group chat, or if you look at the bottom of the screen there is a React. If you go there, you can raise your hand, and when we see that, we'll try and locate you and address your questions at the time. So for today, we're going to go over the agenda is to start off, we're going to have a look at current economic conditions. Then we're going to have a peek in terms of the impact that tariffs have had on the Canadian economy. We're going to then dive into investing for your retirement income, followed by diversification and safety. Then we're going to have a look at equities, the bull case and the bear case. And then we're going to follow that up with a topic on stablecoins. So as we usually do for our webinars, we're going to start off with current economic conditions. So Canada's economy contracted in the second quarter by 1.6%. I should point out that this data point includes all of the data from April, where companies were rushing to ship goods to the US before the tariff deadlines. This had the effect of pulling forward demand and help support GDP. So it's going to be interesting to see the third quarter print when the numbers will more fully capture the effects of the US tariffs. We'll be diving into that in a second. In terms of inflation, after falling from its peak of about 8% from 2022, the pace of inflation has actually steadied and has been holding around the bank's 2% inflation target for the last 12 months. Coupled with a slowing economy, this provided the Bank of Canada with cover to cut interest rates in their last meeting in September, where the Bank of Canada lowered the benchmark overnight rate by 25 basis points to 2.5%. Currently, the market is pricing in a chance for another 25 basis point cut before the end of this year. South of the border, the US economy is showing signs of picking up. After bottoming out in the first quarter of this year, it's accelerated sharply into the second quarter at an annualized rate of about 3.3%. This is expected to accelerate further to about 3.9%, and that data point was put out by the Federal Bank of Atlanta. The negative print that you see in the first quarter, that had to do with imports. So obviously before tariffs, a lot of companies were importing a lot before the tariff deadline. Imports counted as a negative in terms of GDP growth. So that was the reason why it went negative. Otherwise, it would have been a solid print as well for the first quarter. So compared to the Canadian economy, the US economy is a lot stronger on a relative basis, and is why we continue to favor US stocks over Canadian stocks. We'll be diving into this later in our presentation when we go over tariffs as well as our bull case for equities. In the US, inflation is starting to reaccelerate and is well above the Fed's target rate of about 2%. Despite this, the Federal Reserve recently cut their benchmark overnight rate to about 4 to 4.25% at their last September meeting. Do we have any questions up to this point?
And again, as Chris said, we do want to keep it very informal. So please, feel free to use the, raise your hand function, speak up. Definitely, if you have questions, please do go ahead.
Okay, so moving along to the impact of the tariffs. A couple of interesting statistics. Right now, the US import as a percent of their GDP is about 11%. And so Canada's imports as a percent of, Canada's imports as a percentage of US imports is about 14%. So another way to think about that is that out of that 11% that the US imports, 14% of that is Canadian imports. So Canadian imports represent about 1.5% of the US GDP. On the other hand, Canadian exports Canadian exports to the US represent 19% of Canadian GDP. And as a percentage of total exports, US exports represent 76% of all exports that Canadian exports. And so as of September last month, the US had an effective tariff rate. So China had an effective tariff rate of about 40%. Canada, we were the lowest at 6.9%. Mexico, 7.9%. The rest of the world, about 15.6%. And on average, the US average effective tariff rate was 18.5%. As a comparison, the Smoot-Hawley tariffs that were implemented in the 1930s had an average tariff rate of 19.8%. Although Canada's effective tariff rate is the lowest among all US trading partners, early data does suggest that the tariff burden is being shared by the manufacturer and the importer. So retailers are finding it very hard to pass along these price increases to consumers. What this means is less margins for Canadian manufacturers. So it's had a very negative impact on the Canadian economy, given that 19% of our GDP is exported to the US. And between the first quarter and second quarter of this year, Canadian exports fell 26.5%, according to the Canadian Chamber of Commerce. So the bottom line here is that the tariffs are having a much larger impact to the Canadian economy relative to the US economy. And this is, again, another reason why we can continue to favor the US stocks over Canadian stocks. Does anyone have any questions about any of that data or anything there?
I was just wondering, can I talk?
Yeah, absolutely.
Yep,
Go ahead.
please.
You were saying that inflation is going up in the States, but are people still buying in the United States even with us putting tariffs on stuff coming in?
Yeah, that's a good question. So right now, it remains to be seen whether or not the tariffs are inflationary or deflationary. And like I just said, the early data suggests that the tariff burdens are being borne by the manufacturer and the importer. So if you think of a company either in China or Canada that's trying to export to the US, they're having to reduce their cost, or the person that's importing it is eating it, meaning less margins for them. So right now in the US, the actual consumer, they're not really feeling the effects of the tariffs yet. However, it's still early. The data that's coming in has been very choppy due to the on again, off again. I think there's been like 5 on-off switches in terms of the tariffs on, or they're being paused or whatnot. And so the data has been very choppy, but so far it remains to be seen the long-term impacts and whether or not the end retail buyers are actually experiencing cost inflation or price inflation.
The other piece, as Chris said, just further that, it is very, very choppy. I've seen, for instance, in the construction industry, as Chris said, with uncertainty of tariffs, huge orders were placed, ahead of time, and then certain supplies are not being ordered right now. So it is going to take a while to see how it all settles out. And then there is also the long term that, for instance, we look at the beginning of the year, there was a lot of animosity towards Elon Musk and different things in connection with Trump. Now and people were almost scared to drive a Tesla. Now some of that has faded. There was the buy only Canadian in Canada, buy only US in the US. Whether that fades or continues, again, as Chris said, remains to be seen.
An excellent question. Thank you. Anybody else?
Chris, that
Yes.
last, I think it was that last slide you showed, there was an increase, or the previous one, there was an increase in the third quarter, or the last quarter recorded of US sales, GDP growth. Yeah, that one. And the previous one to that was purchasing a lot of stuff in anticipation of the tariffs kicking in, purchasing in the United States.
That's correct.
Now, so the final slide there, the 3.3 you've got, would indicate to me, correct me if I'm wrong, that is the consumption or the use or the sale of those products that were pre-purchased. and they're clearing out inventory. And therefore, as I think you said, or Leon said, the tariffs really haven't hit America yet in general. Would that be fair? And that it could, yet you're talking about some economic growth in the future. I see those two things as incompatible. So help me walk through that.
Yeah, sure. And thank you for bringing that up. One thing that we went over, and it was pretty quick, in terms of the tariffs, let's quickly go over that. Tariffs as a percent of US GDP is 11%. So if you applied an 18.5% tariff rate on that 11%, you're effectively you're effectively taxing the US. It's just under a 2% consumption tax. So essentially a tariff is a tax, and it's a consumption tax based on what you buy.
Right.
And so the effective rate of 18.5% on the 11% that they import, it's a 2% tax for those people that are spending. And so, and again, it is discretionary. So while there are things that are being imported, there's always US goods that are made there that, not for all of them, but there are alternatives. And so, right now, you hear a lot of talks about tariffs, but they really aren't impacting the US economy.
Right.
Yet.
Yes.
But yeah,
Yes.
so far, based on everything that we're seeing, even in the recent consumer data that was just released. So, for example, even auto sales are picking up in the US right now.
Interesting.
Yeah, so we'll see how it plays out. Again, it's still early days with the on again, off again, and that things have been settling down a bit. But right now, there doesn't seem to be a meaningful impact on their economy. On the Canadian economy, certainly we're seeing it, but in terms of their economy, we haven't seen it the impact yet.
The
Thank
other
you.
piece, pardon me, and Chris is going to get in greater detail, but we've also got to remember corporate, and in many cases, personal income taxes are coming down in the United States, particularly on the corporate side. The near shoring, and again, Chris is going to get into that. Maybe I should leave it at greater detail, but there is a lot of moving pieces right now.
Yeah, absolutely. All right, so we're going to segue just a bit here, and we wanted to discuss investing for your retirement income. So what we wanted to show, just basically a case study. And we're going to look at two companies.
Yeah, no, sorry, I was just going to interject a little
Oh.
bit. It's an interesting topic. It's one that I've really wanted to focus on for a long time. Because over the years, one of the questions that always comes up, or one of the conversations, is always around dividends. And particularly as clients approach retirement and are looking at income, there's always the question of dividend yield. How will I get my income? That sort of thing. And one of the things that I've told new clients, prospective clients, and even long-term clients is, if you look back at the last 20 years, we've provided a lot more income for our retirees owning stocks like Apple and Microsoft than, say, a Canadian typical retiree that is owning a company like BCE. One of the difficulties has been how to show that, though, and I think Chris has done a really good job of hopefully helping us gain a better understanding of actually showing the all-in income, or the most important, what at the end of the day is going to give you the most income, the most money. And so I'm going to turn it over to Chris to help us with that.
Okay, sorry, thanks, Leon. Okay, so investing for your retirement income, we're going to do a quick study between Bell Canada and Visa. So over the last 10 years, the dividend for Bell Canada has averaged 6%, whereas Visa's dividend over the same time period have averaged just over half of 1%. So the question is it better for an income investor to hold Bell Canada and collect the dividend, or hold Visa and create your own 6% synthetic dividend by trimming 6% of your position every year? So a couple of assumptions we're going to make. We're going to assume that we bought $100,000 Canadian worth of each stock 10 years ago. Each year, we're going to collect our 6% dividend from passively holding Bell Canada stock. And every year, we're going to sell 6% of our position in Visa to create our own synthetic dividend. And so for this, we adjusted Visa's stock price by the exchange rate so that everything is kind of shown in Canadian dollars. over the last 10 years, you can see that both Bell Canada and Visa increased their dividend consistently over this time period. But what's interesting is that if you track the share price over this period, we show that Visa has continued to grow, and this is even with the 6% that we've sold every year to account for that synthetic dividend. And so in these highlighted areas, that's where we've sold our 6% to create the dividend. So looking at some of the findings, things I wanted to point out, the dividend growth. So again, we started off with about 100,000 in each position. The dividend growth in Bell Canada grew on average by about 4.3% every year, whereas Visa, it grew about 15.8%. What's interesting is that if you the total income that BCE pays over this period is about 56,000. However, by selling 6% of Visa every year over that same 10-year period, we collected over double the quote unquote income. Now, because BCE is paying dividends, you're taxed, assuming at the highest tax bracket, you're paying about 29%. The tax that you're paying on Visa, it starts at 5% and increases to 21%. And just as a reminder, you're only taxed on half of the capital. Half of the capital gain is taxed as income. So the ending value of both positions for Bell Canada, we ended at 61,000. For Visa, it was 290,000. So over the 10-year period holding Bell Canada, your total return, including income, is about 18,400, whereas with Visa, it was over 310,000. One thing that's very interesting and to note is that the dividend payout ratio for Visa was for Bell Canada was really high. In fact, from 2020 to 2025, Bell Canada was paying out more in dividends than it was earning, than the company was earning. So a couple of key points we wanted to mention is not only did we receive higher income from Visa, more than double, the income was taxed at a lower rate, and the ending value of our position is almost 4 times higher. So this is Bell Canada's share price from 2015 to present. You can see that around 2022, essentially, they were giving us, basically giving you back your capital, given that the share price was falling but they're giving you income. So yes, you did still come out ahead over the 10-year period, but relative to Visa, it was a much different story. Did you have anything else to add on that one, Liam?
No, I think, that's the key point is the end of the day, what put the most money in your pocket, most income, most money in your pocket. And, by, as you said, more than double. It's companies like Visa, and we picked Visa and BCE, but we could have picked Microsoft and TELUS. We could have picked, any number of companies. And we used BCE as kind of a median. Obviously, if we would have picked a company like Yellow Pages that was overpaying their dividend even more dramatically to the point that they went broke, the example would be amplified even more. But we just kind of picked a couple companies that we thought were representative of the idea of total income, including share price appreciation, capital gains.
Does anyone have any comments on that or any questions?
So if you're selling down 6% every year of Visa, so when do you run out?
Well, that's a great question. As long as the company is growing more than 6% a year, which Visa did, you don't.
Okay. Yeah. Okay.
Right. So it's a matter of how much are you selling versus the average capital appreciation that you're getting on an annual basis. So with Visa, that's been compounding in the in the mid-teens over that period of time. By selling off 6%, but you're averaging 12% in capital gains, your position is still growing by 6% a year.
Yeah. Okay.
So we also wanted to touch briefly on diversification. So obviously there's a lot of uncertainties in the world right now. And so diversifying across different asset classes and equities are very important. As we discussed, the Canadian economy remains weak. There's increasing US political influence, and we see that with tariffs, certainly the pressure on the Federal Reserve, US judicial system, just three that come off the top of the mind. We have deglobalization happening with moving more towards a bipolar or multipolar world and away from US hegemony. Just think of the recent meeting between China, Russia, and India, joining forces, it seems, economically. Then obviously sovereign debt levels remain sustainably high. Moving on to our next section, we wanted to discuss our both the bear and bull cases for equities. So as discussed at the beginning of this webinar, unemployment, the Canadian economy is feeling challenged right now, especially with unemployment rising to about 7.1%, and that stat was in August. In the US, we're also starting to see unemployment slowly start to tick up. Globalization is unwinding towards more bifurcated economies, growing political influence, which we discussed, and also debt levels in the developed economies remain unsustainably high. We'll touch on this a little bit more when we get into stablecoins. And by almost every metric, stock valuations are historically expensive. It should be noted, though, that if inflation continues to stay elevated due to a strong US economy, we would expect price earnings ratios to remain elevated and maybe even expand further from here. On our bull case side, we're continuing to see high fiscal spending, like record high fiscal spending from governments who continue to support the economy. The One Big Beautiful Bill Act is a perfect example. We'll show a brief, we have a slide on that. Bottom line, it's hard to have a recession when governments are running budget deficits close to 6 to 7% of GDP. Typically, a government would run that during war times, but we're doing that now, both in the US and Canada. Central banks are cutting interest rates globally. So even this past September, the Federal Reserve joined the party and started to cut rates as well. And obviously the Bank of Canada did as well. As we'll show, there is a lot of reshoring happening right now in US infrastructure. Also, if the US Supreme Court upholds the decision that the Trump tariffs are illegal, the amount of tariffs collected so far would be refunded. This represents a $135 billion stimulus to the US economy. What we're seeing under the surface as well is that a lot of leading economic indicators in the US manufacturing and new orders are starting to reaccelerate. And also bank lending and corporate borrowing are also starting to expand in the US. So the bottom line is that since COVID, fiscal spending has been the one thing that's keeping the economy afloat. And so far, we don't see any signs of that letting off. So if we start to see strength in the industrial base, which continues to gain momentum, the US economy could go from a one-engine economy to a two-engine economy. So in terms of the One Big Beautiful Bill Act that was recently passed, this chart represents, in red, we see the benefits from the tax cuts and spending are front-loaded. And you can see that they're kind of peaking out in about 2027. And so all of the benefits of that bill are kind of front-loaded, whereas the costs in the form of government cuts in blue is kind of backloaded. And you see that that peaks out at around 2032. And that's assuming that they happen. So this imbalance of stimulus is very bullish for the US markets over the medium term. Here's a list of companies who have recently made commitments to reshore manufacturing in the US. All of this is in 2025. So you can see that Apple announced $600 billion investment in terms of manufacturing. Project Stargate, which is a consortium led by SoftBank, OpenAI, and Oracle, announced a $500 billion private investment in artificial intelligence infrastructure. NVIDIA is committed to $500 billion over the next 4 years for manufacturing and AI supercomputers. Micron, advanced memory chips, $200 billion. The list just goes on. And even today, there was an agreement made with Pfizer for $70 million in terms of reshoring and manufacturing drugs on US soil. So we're seeing a lot of investments and reshoring happening right now in the US. So this continued fiscal spending, the incentives for reshoring, coupled with the Federal Reserve's lowering interest rates, our base case is that the U.S. government is going to run their economy hot. And so again, this is why we continue to favor U.S. equities over Canadian equities. Does anyone have any questions or comments?
Chris, can I go back to something very briefly? Leon was talking about, and yourself, was diversification.
Sure.
And you're talking about not just asset class diversification, but also geographic diversification. What countries outside Canada and the US do you look for diversification, like China, Europe, India? Where do you, or are you into that?
Yeah, well, if you look at the majority of the companies that we own, you'll notice that a lot of them are global by nature. So, for example, Microsoft, yes, they're headquartered in the US, but they collect about 6% of their revenue from overseas. So we like those types of companies that are already in itself diversified geographically. We've also made moves into Europe. That was right after the tariff announcements. So we did that actually, positioning a couple of our positions actually over there as well, kind of reducing a little bit of our exposure to the US. But for the most part, that the diversification that we're seeking is through companies that do operate internationally.
Thank you.
Yeah, then also a little bit just more specifically, Des, obviously a lot has gone on this year, politically and via other pieces. And, unfortunately, the year started out with Trump being so inflammatory towards many countries. And, obviously we were one of them, Greenland, on and on and on, that there was material effects. So some of what Trump says we tend to consider, immaterial. It's talk, but it doesn't necessarily affect your investments. And a lot of it isn't nice talk, for lack of a better word, but it doesn't affect your investments. One of the things that did happen with the inflammatory comments was pretty much every country around the world that, was allied with the United States questioned, for instance, their defense contracts. So, if you're Greenland, obviously, Canada comes to mind, any country, Europe, do we want to have 100% of our armaments coming from a country where someone is berating us, putting on tariffs, et cetera, et cetera? The simple answer was no. So, all countries across the board started looking, where else can we buy our missiles from? Where else can we buy, our defense products from? So one of the things we did was we bought basically an ETF that was diversified geographically, Europe and these areas in the defense area. I'm sad to say we expect that area to do very well. What we see going on in Ukraine and all over the world, as I say, it disheartens me to say it, but we expect that area to do very well. And particularly outside the United States, there are more and more companies being looked at that traditionally, if you were going to buy a fighter jet, chances are you bought it from Lockheed Martin. If you were going to buy a missile, Raytheon was a leader, et cetera, et cetera. Now people are looking towards German countries, French companies, German companies, French companies, et cetera, et cetera. And there are other areas beyond that. But at the same time, we also want to be a little bit careful. As Chris has said before, we tend to be agnostic where we invest, or we've tended to look for the best companies in the world. But in 2025, we have consciously looked and said, can we buy a company similar to a US company that is going to give us the same profitability, the same earnings growth, that sort of thing? And it is difficult, particularly at a time when, the United States is taking their corporate taxation rates way down. There is all this nearshoring, but we are consciously looking when appropriate to shift money even more outside of Canada and the US, because just as you said, the theme of diversification, we know, people do want to be in more areas than just Canada and the US.
Perfect. Good question.
Thank you.
No, thank you as well. So before we jump in to stablecoins, I first wanted to provide some context as to why we're actually tackling this issue or introducing it. So in our last webinar, we showed the growing size of the US federal debt. It's actually now, like this is an old slide. This is actually from our last webinar, but currently the size of the debt now is about 37 trillion. Skip those. So traditionally, it's been foreign central banks, which is the black line that you see on this chart, as well as US commercial banks, which are the red line, that have been the primary buyers of US treasuries. Over the last decade, you can see that foreign central banks have been actually net sellers. So you can see that since 2008, that black line has been steadily going down. So historically, foreign central banks were not really yield sensitive. So they bought US treasuries as a way to park the US dollars that they got from trade. And they didn't really worry about the yield that they were collecting. It was more just as a store of value for the reserves. So if they're pulling back in terms of their buying, who's buying today? Well, we can see that in the purple line here, which is net private non-bank sector, which are essentially retail investors, the purple line. So they actually hold about 56% of all outstanding US federal debt. Now, these types of investors, they are not, they are yield sensitive. And so they are, you know, that's part of the reason why we're starting to see long-term yields in the US remain a little bit high, is because of this changing dynamics in terms of who's holding the US treasuries. So with the US debt continuing to grow and traditional buyers such as the foreign central bank stepping back, the US government needs to find more buyers for their debt. So that's where enter stablecoins. So a stablecoin essentially is a digital currency that is designed to maintain a stable value by being pegged to an asset, such as a fiat dollar like the US dollar. So you can think of a stablecoin like a digital dollar that you can transfer anywhere instantly at a fraction of the cost. And so if you think of people in companies in different developing countries that want to trade in US dollars, this is what it's been designed for. So it's borderless, lower transaction costs, more frictionless. So last June, the US Senate passed what they call the Genius Act, making stable coins legal. So prior to the Genius Act, there's actually already about 220 billion in stable coins globally, all denominated, backed by US dollars. So to show you, just to give you a sense of the growth, 5 years ago, the amount of stable coins circulation was about 10 billion US dollars. So a couple of key features about the Genius Act, it stipulates that all stable coins must be backed by US Treasury bills. And it also stipulates that holders of stablecoin cannot receive the interest. So think of it like, when you hold a physical dollar bill, you're not earning interest on it. And so that's what they're trying to mimic. So the question, the question is, who gets this interest? And the answer is the issuers of stablecoins. So moments after the Genius Act was passed, many companies announced that they were ready to issue stablecoins. 3 of these companies, like among them were JP Morgan, Visa, and MasterCard, all of our core holdings, who have been working on this project for many years already. And so through the use of stablecoins, the US government is trying to expand the usage of US dollars around the world, as well as to create a new demand supply and a new demand source for their treasury bonds. So it's still too early to see how successful this will be, but we all get to watch as this plays out.